So, I think we left off last time. We had just finished example 4. But just to sort of recap very quickly, we started the corporate liquidation topic, and we went over the key notion that unlike non-liquidating distributions where the tax treatment to the shareholder requires that we examine the earnings and profit situation, in the context of a complete liquidation, the Internal Revenue Code takes a totally different approach. It's basically the unwinding of an investment, and therefore the code, section 331A, provides sale or exchange treatment in effect for the shareholder, earnings and profits being irrelevant. And we discussed the fact that the consequence to the shareholder is the same whether it's a cash distribution or a distribution of property, in which case you just value the property, and for purposes of determining the amount of gain or loss under section 331. We talked briefly about what happens if there are multiple blocks of stock, in which case there's effectively a proration of the liquidation proceeds between the different blocks. Often it won't make a difference, but it can in certain circumstances. We talked about what happens if liquidating distributions occur over more than 1 year, in which case the shareholders are permitted, according to the IRS, to recover their basis in their stock first before recognizing any gain, basically a return of capital approach. And then we talked about what's on the screen, the end of example 4, involving what happens when a property right is distributed by the corporation to the shareholders where there may be some uncertainty as to how to value the asset that's being distributed, and we pointed out that there are alternative possible ways of treating that situation. Either you take the position that the open transaction doctrine applies, which would be available only if you really are not in a position to value the property right that's being distributed, in which case the shareholder would eventually have an amount realized if, as, and when those contingencies are resolved. Alternatively, and probably in the majority of cases, the open transaction doctrine will not apply. In most cases, the IRS is going to insist that the corporation value whatever assets are being distributed to the shareholders, so that the shareholders pick that up immediately as part of the amount realized under section 331 and acquire a basis in that property right equal to that fair market value, which brings up the situation we talked about at the end of last class, which is that the shareholder gets a basis in that asset. In our example, it was a claim against a third party, and if the ultimate amount collected on that claim is greater than the basis of the claim, that's going to be ordinary income, not capital gain, because it's not a sale or exchange.
I have a question.
Yes?
How do we know when the open transaction doctrine applies or not?
That's a great question, and I actually have a problem for a client in my office at this very moment where we are about to research that issue. It's a very fact-intensive inquiry. It's not in the code or the regs. It's been addressed in court cases and a handful of revenue rulings dating back, for the last 50, 75 years. the position of the IRS. When I say the position of the IRS, what I mean by that is just because the IRS has an opinion as to what the tax law is, doesn't mean that it's right. Okay, ultimately, it's a court that will determine what the correct position is. The IRS's position on the open transaction doctrine is that it applies only in rare and extraordinary cases where the property right is just not readily susceptible to valuation. So I can't give you a simple answer to that question.
Would you tell us on a quiz or exam? Like this applies or doesn't?
Yeah, there's almost no way I would ask any students to opine in an exam on that question because the law is so unsettled. So the answer is, if I were to give an exam question on this particular, I call it a what if, I would probably say, well, what would the consequences be if the open transaction doctrine did not apply, or if the open transaction doctrine did apply? That's probably how I would pose it to you, although I don't think, I don't even remember what's on the final exam. I haven't looked at it about a month, so in fact, it's not done yet. I'm gonna have to work on it over this weekend to make sure it adequately reflects what we talked about in class. So that's just sort of a recap of where we ended up at the end of last class. And in today's class, we're going to cover about 3 principal topics fairly quickly. I'm hoping that you all had time to prepare for class. So this example 5 is, I think, one of the most interesting topics, partly because it's multidisciplinary. It's not a pure corporate tax topic. It also implicates accounting method issues under the installment method of accounting. So the facts here are, we have a corporation with a shareholder who owns 100% of the stock. Her basis is $200,000. Corporation has one asset left, land with a basis of $300,000. It's worth $1 million. Corporation is assumed to have no liabilities. In year 1, it adopts a plan of liquidation. By the way, the relevance of that fact, if you recall from last class, one of the first things you have to think about when you're analyzing the consequence of a corporate distribution, you have to ask yourself, well, gee, is this a liquidating distribution or is it a non-liquidating distribution? And the distinction between those two categories is fleshed out in the textbook and to a limited extent in the materials. So here, within 12 months after the plan of liquidation is adopted, we assume that the corporation sells the land for $1 million. But instead of getting $1 million in cash, the corporation gets a $400,000 down payment and a promissory note for $600,000 with adequate stated interest. What I mean by that is that the interest is sufficient to avoid any income tax recharacterization. So under the tax law, you're not being tested on this. If you have a sale of property and the interest rate is below a tax interest rate that's called the AFR, the applicable federal rate, then there are incredibly complicated rules under which interest can be imputed. In other words, a portion of the purchase price can be treated as interest income instead of as potentially capital gain or capital loss. But we're assuming that away here. This $600,000 note has adequate interest. So during the 12 months after the plan of liquidation is adopted, we're assuming that the corporation distributes this promissory note to the stockholder along with its remaining cash. Now, how did I come up with this $225,000 number? Corporation sold the land for $400,000. Well, this is sort of an arbitrary number, but I wanted to make it somewhat realistic here, because the way this works, when the corporation receives the note of the buyer, the corporation initially is entitled to use the installment method of accounting so that it would calculate a gross profit ratio and multiply that gross profit ratio times the $400,000 cash amount. That would be the way the installment method usually would apply. I kind of shortcutted it here because in the next step, when the corporation transfers the note receivable of $600,000 to the shareholder, that transfer causes the corporation to recognize the remaining unreported gain inherent in that note. Or put another way, if the corporation were not liquidating, ordinarily it wouldn't have to recognize any gain on the $600,000 note until it collected the principal payments on that note. But in the context of a liquidation, when the note is transferred by the corporation to the stockholders, in a way it's unfair because I'm skipping ahead to the next topic, which hopefully you've read. 336A provides that on a liquidating distribution of property, the corporation recognizes gain or loss equal to the difference between the fair market value of the property and the basis in the property. We're going to cover that in just a few minutes. Here, when the property that's being distributed is a promissory note of $600,000 face amount that's being reported under the installment method, the note distribution triggers the gain inherent in that note. To make a long story short, and this is only relevant vis-a-vis this factual assumption, the approximate amount of tax liability that would be incurred by the corporation by reason of having sold the land for $1 million would be roughly $175,000 of taxes. So if it received $400,000 of cash, and if it were liable to pay $175,000 of tax liability, it would have $225,000 of cash left to distribute to the stockholder. That's sort of a long-winded way of giving you my factual assumptions here. I don't expect you to understand all the nuances of the installment method, but I thought it would be interesting to play this out. What happens here is that these factual assumptions were critical because the general rule would be that in the absence of Code Section 453H, which is illustrated in the example, the general rule under Section 331 would be that when the shareholder receives this $600,000 note from the corporation, it would have to report an amount realized right away based on the fair market value of that note, even though the note hasn't been paid yet. This is different than an earlier example we discussed at the end of the last class, where the corporation is just sitting on cash and it distributes some of the cash in liquidation in year 2 or year 3. In that situation, it's permissible for the shareholder to wait until it receives that cash to report it under Section 331 as part of its amount realized. But here, where the corporation is actually transferring the $600,000 note to the shareholder, unless 453H applies, the shareholder would have to value that note and pick it up in its amount realized under Section 331A immediately. Okay? However, the beauty of 453H is that this provision tells us that if the promissory note meets a whole bunch of criteria, which are, I'll come to in a minute, they're basically embedded in the factual assumptions here, then the shareholder doesn't have to pick up the value of the note in its amount realized. Instead, the shareholder is allowed to calculate its own gross profit ratio and report the note and any other liquidating distributions under the installment method. This is a pro-taxpayer rule. And the example here illustrates how the calculations work. Let me ask you a question. Did you study the installment method with Professor Solet at all? Okay. Then what I think I'm going to do is, well, I don't think you're going to be tested on this, but this is a good thing to talk about because it sort of highlights, in a big picture sense, what's going on in the context of liquidation. So I would suggest to you that you go through the example to try to understand the arithmetic. I'm not going to test you on it, but the point of the example is that I wanted to reinforce in your mind the general rule under Section 331 that a shareholder has a sale or exchange with respect to his or her stock equal to the cash and the fair market value of the property that's distributed minus the basis in the shareholder's stock. This example is kind of an exception to that general rule because it tells us that if the corporation, and this is pretty common, the corporation liquidates, often it's going to be selling off its assets, right? So this is a significant provision in the sense that if the corporation sells its assets within 12 months after it adopts a plan of liquidation, and if it takes back the buyer's promissory note, and if that note is distributed within that 12-month period, along with all the other assets, then if all of those requirements are met, the corporation doesn't avoid tax. The corporation still has to pay tax on the distribution of that note. But the benefit here is that the shareholder can use the installment method to defer the taxable event under Section 331. It's a fascinating topic that has implications outside of C Corps. There's some special rules for S Corps, and if those of you who may pursue a career in tax accounting will undoubtedly get into this fact pattern in much more depth in the future. One other point here is that when a shareholder receives this type of promissory note, if it wants to, the shareholder is permitted but not required to elect out of the installment method. What I mean by that is that the installment method is a default rule, meaning that when a seller of property receives a promissory note that otherwise qualifies under the installment method, the seller is automatically entitled to defer the reporting of the payments on the note. But sometimes there might be situations where your client is selling property for a note and he or she might want to accelerate the gain into the year of sale. There are all kinds of situations that could justify that sort of an approach. So you can elect out and voluntarily pick it up in your gain. I don't want to confuse you, but last class, remember we talked about the concept that the IRS allows the taxpayer, when the corporation is distributing cash in liquidation, the shareholder doesn't have to report that cash until it's actually received. But I asked the question at the end of class, can the shareholder voluntarily report the undistributed cash as part of a capital gain in the year of liquidation, even though the cash hasn't been received? I don't know the answer to that question. It's kind of weird because in the context of the installment method, it's clear that the shareholder can elect out and accelerate the promissory note into its amount realized, yet we don't seem to know if the same election is available for the cash that is still accumulated within the corporation. All right, enough on that. We're now going to talk about what I already just sort of talked about, which is the corporate level consequences of distributing property in liquidation. And on this page 10, this is sort of an introductory page, which is a preview, kind of a flow chart in a way of what's to come. So as you think through a liquidation of a corporation, again, you gotta drive this point home. You've got two layers of taxable events. You got a taxable event at the corporate level when it sells its assets or distributes its assets, and you got a taxable event to the shareholder. So, how does that play out? First, you have to ask yourself, are we liquidating an 80% or more subsidiary or not? If it's an 80% or more subsidiary, commonly referred to as a 332 liquidation, the parent corporation, the 80% or more shareholder, is subject to section 332, meaning that it ordinarily has no gain or loss. Come to that in about half an hour. The subsidiary in that type of liquidation, subject to section 337, meaning, you've done your homework, ordinarily no taxable event. But then there are special rules for minority shareholders, in which both the corporation and the less than 20% shareholders could have a taxable event. Other liquidations, which is what we've been talking about so far, 331 liquidations, where basically it's everything other than a 332 liquidation. A liquidation where the shareholders are primarily individuals, or put another way, where you don't have a parent corporation with 80% or more control. In that situation, you have all of the rules we've just discussed regarding section 331. Those rules apply whenever there's a liquidation of a corporation that's not an 80% or more subsidiary. And in that type of a liquidation, the corporation, the liquidating corporation, is subject to section 336, which we're about to dig into, under which the liquidating corporation generally is going to be recognized in gain or loss. I mentioned that in the context of a corporate liquidation, it's pretty common for the corporation to sell off most, if not all, of its assets, and those types of transactions are tested under regular tax principles, having nothing to do with corporate tax. Just apply the usual tax rules. What about a sale of stock? Well, that's not a liquidation. But it's important to think about that in your head. If a corporation is being acquired, a lot of business people are sloppy with their terminology. They say, oh, the company is being sold, without telling you, gee, what do you mean by that? Is the corporation selling its assets? Or are the shareholders selling their stock? Two different ways in which a company can be sold. It's actually more than two, but we don't have time to get into that. But generally speaking, if it's a sale of stock, shareholders just recognize capital gain or capital loss, equal to the difference between the selling price and their basis. And the buyer gets a cost basis in the stock. And in that situation, generally, there's no change in the basis of the assets held by the corporation. And the corporation's earnings and profits don't change. If it has net operating losses, NOLs, accounting methods, they all stay the same, generally. As you've seen, there are exceptions to almost everything. There are special elections, which we're not going to cover, but this is hugely important if you get involved in mergers and acquisitions work, under which, even though the shareholders are selling their stock in the corporation, the parties can make certain types of elections so that the transaction is treated as if it had been a sale of assets. Fascinating topics. And again, you'll pick that up over time as you go through your career. So that's all kind of a preview. I'm going to skip over the historical background for the moment. And we'll go to the basic case here for what happens to a liquidating corporation when it distributes appreciated property in a liquidation. So, facts: that a shareholder owning 100% of the stock, who has a tax basis of $200,000, corporation adopts a plan of complete liquidation. We're assuming that the corporation has land with a basis of $400,000, fair market value of $1 million, no liabilities, and it distributes the land to the sole stockholder in liquidation. We're assuming that the stock is a capital asset in the hands of the shareholder, and that the shareholder has a long-term holding period. So the example then walks through the results at both levels. Anyone want to take a stab at this? At the corporate level, general rule of section 336A, when property is distributed pursuant to the liquidation of the corporation, it's a sale or it's a deemed sale or exchange. The code says that the corporation recognizes gain as if it had sold the property for fair market value to the shareholder. So the code basically sets up a hypothetical sale by the corporation of its assets to the shareholder. Here, the land has a value of $1 million. It's got a basis of $400,000. So if there were a hypothetical sale of that land to the shareholder, what would happen? A sale or exchange, amount realized of $1 million, $600,000 of gain would have been realized, and the code 336A tells us that there is a recognition event. So the corporation has $600,000 of gain on that distribution, even though it's not getting any cash. Basically the same result that we studied under section 311B1 for a non-liquidating distribution of property. Now in this example, in the real world, I should say, once the corporation has $600,000 of gain, it would have a tax liability, which would reduce the remaining assets to be distributed to the shareholder in liquidation. I'm ignoring that fact just to make the example, to dumb it down a little bit. So at the shareholder level, since we're ignoring that tax liability at the corporate level, we're assuming that the shareholder is receiving $1 million of assets, land worth $1 million. We know that the shareholder has a basis of $200,000. So we go back to section 331A, which we started last week. Long-term capital gain of $800,000. And what's the basis of the land once it becomes owned by the shareholder?
Fair market value.
Right, fair market value. And the reason for that is the code says so. Section 334A tells you that in this kind of a liquidation, the Just as in a non-liquidating distribution where, I forget which subsection of 301 tells us that the basis of the property received in a non-liquidating distribution becomes its fair market value. Same thing here. But it makes sense intuitively also because it's a taxable event. So the character of the gain recognized by the corporation, I mean, we sort of answered that question here. The deemed sale of the land to the shareholder. Here it's land, which is a capital asset, it's the long-term capital gain. What would have happened if the corporation had distributed inventory instead of land?
Ordinary income,
Ordinary income. Why is that?
because it's not a capital asset.
Right, exactly. And this is sort of a trick question. What if the property distributed was not raw land, but it was a building subject to depreciation? Or equipment subject to depreciation?
Would it still be capital if it's a capital asset?
Well, that's a good question. Yes.
Would it be ordinary income recaptured, and then the rest would be?
Well, my question was unfair because the answer is different depending upon whether it's equipment or a building. But that's a great partial answer. Yes, if it were equipment, it's possible that there would be depreciation recapture at the corporate level. And the corporation might not care because it's a C Corp, and it might not matter whether it's ordinary income or capital gain. But it could. Corporation could have capital losses, which can only be offset against capital gain. And if it's a depreciable building, there's a special rule in the tax code. I don't know if you studied it. Yes.
Would that be 1250 or would it not apply here? Like the unrecaptured 1250 gain?
Unrecaptured 1250 gain is only relevant to non-corporate taxpayers. That's the provision that says that upon a sale of real property, depreciable real property, which ordinarily would have given rise to Section 1231 gain, which ordinarily, if it's recharacterized in the hodgepodge as capital gain, would be subject to a maximum 20% tax rate. The unrecaptured real property, it's the precise terminology is I don't remember the precise terminology. Unrecaptured 1250 gain. That's what it is. That's subject to a special 25% tax rate instead of the normal maximum 20% capital gains rate that would apply to individuals. That's not going to be relevant to a C Corp, which is subject to a flat 21% tax rate. No, what I was getting at here, and it's sort of a trick question, Section 1239 of the code provides that if there's a transfer of property to a related party, and if the property would be depreciable in the hands of the buyer or the transferee, then the capital gain or 1231 gain that would otherwise be recognized by the seller or transferor is treated instead as ordinary income. You're not being tested on that. But the point is that you got to think about these things. Never take anything for granted. Here, all you really need to know is that 336 says gain or loss is recognized at the corporate level as the general rule, and the character of that gain or loss requires that you look at other tax principles to make that determination. Next example, example 7, page 12. What happens if basically the same fact pattern, property with fair market value greater than basis, but the property is subject to a liability that's less than the fair market value of the property. Well, it may sound familiar because we had a similar example in the context of non-liquidating distributions. And the analysis here is essentially identical at the corporate level, but for different, there are different citations. The code says that under 336A that the corporation is treated as if the land were sold for fair market value. Here, fair market value is greater than the amount of the debt. So the liability just has no effect at the corporate level. It would have an effect if the liability were greater than the fair market value. Okay, that's the next example. I'm jumping ahead of myself, sorry. Hold that thought. At the shareholder level, again, this is similar to what we studied for non-liquidating distributions. The liability is taken into account. And think about it economically. It makes sense. Look at what the shareholder netted in an economic sense. Yeah, the shareholder got land worth $1 million, but there's also a $700,000 liability that effectively reduces the net value of what the shareholder receives. So that liability has to be subtracted. So this net value of $300,000 minus $200,000 of basis long-term capital gain of $100,000. So the key points, which I just said, the liability has no effect on the corporate level gain so long as the liability is less than fair market value. But the liability does reduce the shareholder level gain. And switching to the fact pattern where the liability is greater than value. So in this example, we're assuming that the land is still worth $1 million, but it's subject to a mortgage of $1.2 million. It's essentially similar to what we studied for non-liquidating distributions. The code has a kind of a fiction here that the property is deemed at the corporate level to be worth at least the amount of the debt. So when you go through the Section 336 analysis of how much gain is recognized at the corporate level, 336A says corporation treated as if the land were sold to the shareholder for fair market value. But then when you look at 336B, that provides fair market value shall be treated as not less than the amount of the liability that encumbers that property. So here, again, it's a kind of a bifurcated approach in the sense that the liability did not have any impact at the corporate level, but when you look at the shareholder level, it's a negative. The shareholder received land worth $1 million, a mortgage liability of $1.2 million. So how do we analyze that? Well, this is a little bit tricky. When this fact pattern, where the mortgage liability is non-recourse, that means that the owner of the land, the shareholder, is never going to have to reach into his or her pocket to pay off that debt. In other words, the lender's only remedy is to take back the property by a foreclosure proceeding. So because of that fact, the tax law doesn't allow the shareholder to have a negative here. In other words, you might think, gee, I didn't really get a net zero in the liquidation. I really got a negative $200,000, and I had a basis to begin with of $200,000 in my stock. shouldn't I be entitled to a $400,000 loss rather than a $200,000 loss? But the answer is no, because when this fact pattern with a non-recourse liability, the shareholder is treated as if he or she got nothing. But because there's a $200,000 basis in his stock, there's a loss recognized. And again, this kind of gets tricky. And I don't think I'm testing you on this, but technically, if the corporation is insolvent, and that's basically this fact pattern, if you have a corporation that's got liabilities that exceed the value of its assets, there's really no net value available to distribute in liquidation, right? So the tax law has evolved to the point where the usual technical outcome here is that at the shareholder level, Section 331 doesn't even apply. Because 331, if you look at the code and read it very carefully, it applies only if amounts are received by a shareholder with respect to his or her stock. Here, nothing is received. But there's a happy ending. The shareholder can still claim a loss, except that most lawyers believe that it's under Section 165 of the code, which is the general rule in the Internal Revenue Code for recognizing losses. So when the dust settles, the shareholder has a $200,000 loss on this fact pattern, probably under Section 165 rather than under 331. And it's on this fact pattern, it's a capital loss, not an ordinary loss. There are circumstances in which a corporate shareholder might be entitled to claim an ordinary loss on the liquidation of an insolvent corporation. Again, that's a more advanced issue. And again, I keep repeating myself, but I do believe it's appropriate, even in a course like this, to throw these advanced issues at you from time to time, because I don't want to lead you to believe that this is like, you know, Cliff Notes. Do they still make Cliff Notes?
Yeah.
Okay. There are so many nuances here, and I just want all of you to be careful in your thinking. I don't want you to come away from this course just, you know, with a bunch of index cards or notes thinking, okay, these are the rules. There are exceptions to the rules and exceptions to the exceptions that we haven't even gotten into, but I'm trying to get you to think in the right direction. And maybe some of you will, you know, be stimulated to look at this in more depth in the future. All right, so we've got 47 minutes left for two final topics, which is kind of ridiculous in a way. And I may go over about 5 minutes or so, because I am staying, by the way, to hand out quizzes and talk about the answers and anything else you want to ask me. But the last two topics are special rules for distributions of lost property. When I say lost property, I mean property that has fair market value less than basis. Remember the general rule, 336A? When a corporation liquidates and distributes property, recognizes gain or loss under 336A. Well, there are a whole bunch of exceptions to that. And I would say that the exceptions, this is probably the most complicated topic in the entire course. For those of you who have tried to read the materials, you might agree with me. The topic after this is a little bit easier. That's subsidiary liquidations. What happens when the corporation that's being liquidated has as one of its shareholders an 80% or more corporate shareholder. So, with no further ado, I'm going to unfortunately have to rush through these examples. But I do want you to interrupt me if I am going too fast. If you haven't read the materials, you're not going to be able to follow. So we have the fact pattern here, if you've noticed, is almost identical in the sense that I'm assuming a 60% shareholder and a 40% shareholder. Shareholder A owns 60%, shareholder B owns 40%. They are unrelated to each other. And the assets, I think in almost every example, are the same. Namely, there are two $400,000 assets. I call it gain property and loss property. The gain property has a basis of $100,000, a value of 400. The loss property has a basis of 800,000 and a value of 400. And the corporation also has cash of $200,000. Just makes the arithmetic simpler. Corporation has no liabilities, and in this example, we're assuming that these assets were purchased by the corporation for cash. In other words, they were not acquired by contribution from the shareholders. Corporation adopts a plan of liquidation. It distributes the properties to the shareholders as tenants in common. That's just a legal term to mean that each shareholder gets an undivided percentage ownership interest in the property. Typically, that's with real estate. It would mean that shareholder A would have a 60% direct interest in the property, and shareholder B would have a 40%. Both of their names would be on the deed. And the $200,000 of cash in this example is assumed to be distributed pro rata. So each shareholder gets his or her proper net value. Everyone follow the facts? Okay. So when you look at this at the corporate level, you have to ask yourself, okay, are there gain assets or loss assets? And here we know we have one gain asset. The general rules that we've already talked about kick in. The fact that there are loss assets do not affect what happens to the gain asset. So here, fair market value of $400,000, basis of $100,000. Corporation recognizes gain on the distribution of that asset. Doesn't matter how that was distributed, whether it was pro rata, non-pro rata, to a related party, to an unrelated party. Well, if it was distributed to a related party, it might affect the character of the gain, but it doesn't have any implications for the analysis of the loss property. For the loss property, in order to understand this, in order to understand any of these examples, you have to understand all of the examples. Really, the only way to get through this, even for an experienced tax person like myself, is to go through it all. When you're done with all the examples, your head will be spinning, and go back to the beginning, reread each example. It actually starts to make sense. So there are three rules under which, again, the general rule under 336A, loss is recognized by the liquidating corporation. There are these three rules that say, shut that rule off, and the loss is not going to be allowed. The first one, in 336D1A, 1i, kicks in if there is a non-pro rata distribution to a related party. I think I discussed this a few classes ago. The difference between pro rata and non-pro rata. That's not really a legal term, but it's a term that everybody uses. A pro rata distribution means that every shareholder gets his or her percentage of every single asset. Whereas a non-pro rata distribution would be if I were to tell you that the corporation distributed the gain property only to shareholder B. That would be non-pro rata. So the first loss disallowance rule, on these facts, doesn't apply. And the other examples that come ahead, in fact, let me do it this way. And again, because of time constraints, in this fact pattern, these 3 bullets up on the screen, this is just formatted this way to assist you in walking through the analysis. The disallowance rules just don't apply in these facts. We haven't talked about them yet, but when you go through those disallowance rules and you analyze each one and you see, okay, they don't apply, and you get back to the general rule of section 336A that the loss is recognized. So on these facts, the disallowance rules don't apply, and you can demonstrate that for yourselves by further review of the examples. I will go through each disallowance rule separately momentarily. At the shareholder level, the key thing to remember here is that the fact that the corporation might have a disallowance of a loss under any of these special rules has no effect at the Section 331 shareholder level. And also distinguish the rules we studied for non-liquidating distributions. We had a non-liquidating distribution of a loss asset. The loss is always disallowed. No exceptions. Whereas in liquidation, we have a different analysis. General rule, loss is allowed unless an exception applies. As an aside, sort of an advanced point, Section 267 of the code provides that when property is sold or exchanged with a related party, the seller or the transferor is not allowed to recognize the loss. So you might be thinking, well, gee, how can you have a loss under 336A at the corporate level if the shareholder, let's say you had a sole shareholder, clearly a distribution of property by a corporation to its sole shareholder is a distribution to a related party, yet the code allows the loss to be recognized at the corporate level, and the only reason is because if you look at Section 267, it says that it doesn't apply in the context of a liquidating distribution. So you don't have to worry about that. You're not being tested on that. So let's look at some of these complicated loss disallowance rules. Example 10 on page 17. Here's where we have a non-pro rata distribution of lost property to a related party. We have the same facts regarding the assets owned by the corporation. And we're assuming that the 40% shareholder, A, I'm sorry, he's 60%. The 60% shareholder, A, receives the lost property worth $400,000 and the $200,000 of cash, and the shareholder B gets the gain property. And that makes sense, right, economically, because each shareholder is getting proper amount of assets. It's just that it's not pro rata. So when you analyze this at the corporate level, the gain property, no change. It's not affected by any of these loss rules. The loss property, okay, here's where the fun begins. Three loss disallowance rules. We're looking at the first one, 336 D1A, 1 to Y, on the top of page 18. That rule kicks in if there is a distribution to a related party and if the distribution is not pro rata. Well, that's what we have here, because shareholder A owns more than 50% of the stock and therefore is considered a related party. And the distribution is considered to be non-pro rata because shareholder A is getting the entire distribution of this asset. Instead of it being split 40-60 between the two shareholders, shareholder A is getting the whole asset. That's non-pro rata. So the loss is disallowed at the corporate level. Why does the tax law provide for this result? Again, blame Enron. This is another one of these anti-abuse rules where it's not just Enron, yes?
Does it have to be combination of related and non-pro rata, or can it be either or?
It has to be, in this situation, it only has to be a non-pro rata distribution to a related party.
What if it's a non-pro rata to a unrelated party?
Now you're pushing it. I'm just kidding. We're going to illustrate each permutation in the other example. So can you hold that thought? In this particular example, the two other loss disallowance rules don't apply because they would have kicked in only if the property had been previously contributed to the corporation in a 351 transaction, which we studied, it seems like years ago, but it was only like 2 weeks ago. So in this example, again, there's no effect at the shareholder level, and we have a disallowance of loss at the corporate level. Interesting to note that it doesn't matter how the corporation acquired the property, whether by purchase, Section 351 transaction, or otherwise. I'm going to skip to the next example, which is example 11 on page 19. Here, we assume a distribution of lost property on a non-pro rata basis, but to an unrelated party. And again, the facts are essentially identical in terms of the asset profile. And we're assuming that the assets were purchased by the corporation and not acquired in a 351 transaction. And we have, as in the prior example, a non-pro rata distribution, except here, instead of having the lost property go to shareholder A, who was a 60% shareholder, it goes to shareholder B, who's a 40% shareholder and therefore unrelated. Gain property, the analysis is not affected, and when you go through the loss disallowance rules, here, because of the fact that shareholder A is not, I'm sorry, shareholder B, who got the lost property, is not related to the corporation, 336D1A does not apply. Neither of the two rules within that section would apply. And 336D2 doesn't apply because we haven't covered that yet, but there are no facts in this example that would indicate that fact pattern. So in this example, when you work your way through it, you reach the conclusion that all is fine at the corporate level and the loss is deductible. The key point here is that the loss disallowance rule in 336D1, as opposed to D2, applies only if it's a distribution to a related party.
Is this the, I'm getting confused between the perspective. Is this the loss for the corporation or the shareholder right now that we're talking
No,
about?
everything we're talking about now is the loss at the corporate level.
Okay.
In other words, we're starting with the premise that we have a general rule under 336A that losses are recognized on the distribution of property with basis greater than fair market value. That's the default rule. We now have these exceptions in 336D. 3 exceptions within 336D. There's also an exception that we'll come to in a couple minutes involving a subsidiary liquidation. So the task here, whenever you see a fact pattern in which there's a distribution of property with basis greater than value, is to ask yourself, okay, do any of these ridiculously complicated exceptions possibly apply here?
You answered the question.
Okay. So what I tried to do, and this may be a faulty teaching method, it's hard to say. I prepared these examples to try to give you the ability to follow how this all plays out. And frankly, this assisted me in reinforcing my own knowledge. It's very difficult to understand these rules just by reading the textbook or the Internal Revenue Code sections. You got to work your way through the numbers. All right, so this example assumes that we have a lot of bad guys who are doing something possibly illegitimate, because the facts, which you have to read carefully, the same basic numbers, but the facts assume that the lost property, instead of having been purchased by the corporation, okay, wait, I stand corrected because the bad guy example is coming up ahead. This is a sort of a lukewarm bad guy example, because this does not involve evil intent. I apologize. This example, example 12, to be clear, involves the fact pattern in which the lost property had been contributed in a 351 transaction at a time when the property had basis in excess of value. But assume that there was otherwise a legitimate business purpose for the transaction. And I say that only because there's a separate loss disallowance rule where the evil intent is involved. So in this fact pattern, we assume that there is we assume that there's a pro rata distribution of both properties to the shareholders, as well as a pro rata distribution of cash. So, what are the results? Again, no change in the analysis of the gain property. And you look at the lost property, and you have to look at the facts carefully. The first loss disallowance rule, which ordinarily might kick in if there were a non-pro rata distribution to a related party, doesn't apply because of the fact that we're assuming that the lost property is distributed on a pro rata basis. So we can cross that off our list. The second loss disallowance rule, which potentially applies if there is a pro rata distribution of disqualified property to a related party, well, that provision is potentially applicable because the property was acquired by the corporation within the last 5 years in a 351 transaction. That's what the code provides, by the way. Namely, that the property would be defined as disqualified property if it were acquired within the last 5 years in a 351 transaction. And this provision, though, applies only if there's a distribution to a related party. So what do we have here? Well, we had a pro rata distribution. So 40% of the lost property was distributed to shareholder B. 60% of the lost property was distributed to shareholder A. How do you analyze that? Well, each shareholder is viewed separately. Shareholder B, who has 40%, is not related to the corporation. Therefore, the distribution of a 40% interest in the property does not trigger the loss disallowance rule. However, the distribution of the 60% interest to shareholder A does cause a problem because we have a distribution of lost property that was acquired within the last 5 years in a 351 transaction at a time when the property had a built-in loss, and now there's a liquidating distribution to a related party. Oh, I get out of breath just saying that. And the third loss disallowance rule, we still haven't come to the example yet, but on these facts, that rule doesn't apply because we don't have evil intent. That's only because of the factual assumptions. Okay, and I'm going to correct a misstatement that I made. I apologize in advance, but the way the code is written, and this is a good example of how confusing these rules are, there's a distinction between the evil intent rule, the third loss disallowance rule, and the disqualified property rule, which I just described, but I described it incorrectly, and I'm comforted that none of you corrected me. But I did make a mistake. The way you analyze this code section is you look at whether the property has a built-in loss at the time of the liquidating distribution, not at the time that it was contributed in a 351 transaction. Whereas in the case of the evil intent rule, let's skip to the example. Example 13 on page 24. Illustrates the problems that can ensue if the property is contributed in a 351 transaction. Doesn't necessarily have to be within a 5-year period. There's a different test under section 336D2. And the code has a more of a facts and circumstances approach by which you can run into trouble here if a principal purpose of contributing property with a built-in loss was to enable the corporation at some point in the future to recognize a loss on liquidation. It seems like a far-fetched fact pattern, but there are people who are actually gaming the system to try to take advantage of these rules. And as a result, the way 336D2 works is that the code looks to the amount of built-in loss at the time of the contribution, whereas the other rule, under 336D1, looks to the amount of built-in loss at the time of the liquidation itself. So I'm going to skip over the rest of this only because of time constraints. And what I would urge you to do is go through the numbers to the best of your ability. There will be I do expect you to have some basic understanding of how these rules work. If you can walk your way through these materials, or the textbook has 2 or 3 pages, I think, on it, which I think is a pretty decent discussion. I think you should get the hang of it. But I just don't want to run out of time for the subsidiary liquidation talk. Any questions?
We just high level, there's 3 exceptions. The first one is just if you're a related party, right? And the second one, unrelated party.
Yeah, I can highlight.
What's the third?
The first one, and the code sections are important here. 336D1A, 1 little I. In fact, let me get that up on the screen. Okay. The first one, this section, is the rule that applies to a non-pro rata distribution of lost property to a related party. To a related party. And this is in the fact pattern where the property has a built-in loss at the time of the distribution. The second rule, 336D1A2, kicks in when it's a pro rata distribution of lost property to a related party, but it's considered disqualified property. In other words, if the property has been acquired in a 351 transaction within the last 5 years, even if it had a built-in gain at the time of the 351 transaction, if it has a built-in loss at the time of the liquidation, and if it's distributed to a related party in a pro rata distribution, then that rule kicks in. The third rule, under 336D2, can kick in whether or not it's a pro rata distribution or a non-pro rata distribution, if there is an evil intent as defined in the code, and if the property had built-in loss at the time of the contribution, as distinguished from having built-in loss at the time of the distribution. I think that high-level approach is also summarized in the textbook. Okay, let's skip ahead to page 30, example 15. So here we have a simple fact pattern where corporation owns 100% of the stock of another corporation. You got to get the terminology straight here. Not so much to understand the technical rules, but in terms of whatever career path you take, in terms of being able to communicate with other accountants, lawyers, business people. Parent and subsidiary. Parent is usually used to refer to a company, could be a corporation, doesn't have to be, that owns usually an 80% or more interest in another company. Here we're only talking about corporations, where a parent corporation owns 80% or more of the stock of a subsidiary corporation. We're assuming the basis that the parent has in the sub stock is $40,000, and that sorry, I lost my place. And the subsidiary has $100,000 of cash left, which it distributes pursuant to a plan of liquidation that complies with Section 332 to the parent corporation. The basic concept here. If you were applying Section 331 here, parent has a basis of $40,000 in stock, it gets $100,000 of cash, it realizes $60,000 of gain. The code, 332A, says no gain is recognized. Why is the rule here different than it is in the context of a regular 331 liquidation? Basically, to avoid multiple levels of taxation and to enable corporate groups to reorganize without getting slammed with excess tax liabilities. Because otherwise, and we talked about this in the context of dividends going up the chain of ownership. If you had a tax on a subsidiary liquidation, every time, you could have 20 subsidiaries going up the chain of ownership. So this has been embedded in the tax law for many years. So if the subsidiary has earnings and profits, and it liquidates up into the parent corporation takes over the earnings and profits of the subsidiary. It also takes over or inherits other tax attributes, such as NOLs, that stands for net operating losses, and other items, so that they don't get lost in the shuffle. Okay, so how do you liquidate a subsidiary? Well, there's some tricky procedural rules. They're discussed in the materials, the textbook, and there are a couple of handouts. It's very important to follow these rules. They're very mechanical. Parent has to own at least 80% of voting power and at least 80% of the value of all the stock. But it has to meet those thresholds on basically, I shouldn't say two separate dates. Initially, at the time it adopts a plan of liquidation, and at all times continuing until the liquidation is completed. And this can cause an issue. Sometimes you might see fact patterns. There are a couple of revenue rulings that I assigned where corporation might not be owned 80% by the parent, it might be owned 70-30. There might be a parent owning 70%. And it figures out a way to buy some of the 30% stockholder stock to push its ownership up to 80%, and then adopt a plan of complete liquidation. The But there have been situations where the IRS has said, no, wait a second, we see that you had documents while you were still only a 70% stockholder to try to, come up with a plan of liquidation, which seems unfair in a way, but the rules are very mechanical. They're also mechanical in terms of this next bullet on the page, the timing requirements. The liquidation of the subsidiary has to be completed in two different ways. Either just get it done within 1 year, one taxable year, regardless of what the plan of liquidation says, or there's a special 3-year rule, which basically says that after you adopt the plan of liquidation, and assuming that the plan expressly provides for a 3-year completion of the liquidation, the 3-year period is measured from the end of the year in which the first distribution is made. So you really could get, 3.5 or more years to finish. And this in turn implicates some interesting procedural rules by which, and you'll see this if you prepare tax returns, the corporations are required to do what we call a waiver of the statute of limitations, meaning that the corporation has to voluntarily keep the statute of limitations open just in case it doesn't ultimately comply with this 3-year rule, to give the IRS an opportunity to go back and assess any tax if it turns out that the corporation did not comply with any of the requirements. The IRS doesn't want to be whipsawed. So we have to run through the rules now for what happens at the corporate level, at the subsidiary level, and what happens at the parent level. We've already talked about the parent level. Excuse me. The basic rule at the parent level, Section 332, no gain or loss. That's pretty simple. At the corporate level, in this example, we assume that the parent has basis of $40,000 in the stock. The subsidiary has land with a value of $100,000, a basis of $25,000. And assume we comply with all of those procedural requirements for a 332 liquidation. By the way, 332 liquidation is the shorthand that we normally use when we talk about liquidating an 80% or more subsidiary. So here the subsidiary is doing what? It's distributing land with a value in excess of basis. Well, usually you might think, well, gee, that would be a taxable event under Section 336A, but there's an exception under 337A by which the liquidating corporation is not required to recognize the built-in gain in the land so long as it's distributing the property pursuant to a valid 332 liquidation to an 80% or more parent corporation. At the parent level, this is basically just repeating the rule we just described. Parent receives the land worth $100,000. Even though the parent has a basis of $40,000 in its stock, and it realizes a gain of $60,000, no gain is recognized under 332A. And here's a really interesting rule. What basis does the parent get in the land? Remember, the parent had a basis in its stock of $40,000 in the sub, but the sub had a basis in the land of $25,000. The code provides that the parent gets stuck with the $25,000 basis of the land in the hands of the sub, meaning that the fact that the parent had excess basis in the stock of the subsidiary is effectively wasted. It's eliminated for all time. Consistent with the fact that it's a non-recognition transaction with a transferred basis, parent gets a tax holding period in the land under 1223(2). So the key points here, top of page 33. The risk of repetition. Subsidiary does not recognize any gain or loss on a distribution to an 80% parent corporation, so long as the liquidation complies with 332. Now, if I change the facts on you, and if I told you that the property was lost property, you probably don't want to hear about lost assets anymore after that horrible topic. But if lost property is distributed to an 80% parent shareholder, same result. In other words, 337 protects the subsidiary from recognizing any loss. It protects, it's actually a bad outcome. It means that the loss is not recognized to the same extent that gain is not recognized. And we already mentioned the fact that the parent's basis in its stock effectively vanishes. It inherits the basis of the assets that are distributed in this liquidation. I'm going to skip the advanced issues, and I think these are the final topics. Minority shareholders, and I am going to run over at least to 4:05 to cover these last topics. So, remember the basic fact pattern here. In order to have a 332 liquidation, which has a twofold benefit, the 80% parent stockholder avoids recognizing gain or loss on its receipt of the distributions, and the subsidiary that distributes the property to the parent doesn't have to recognize gain or loss on those distributions. That kind of all makes sense. But what happens if the subsidiary is not owned 100% by the parent, but it's owned somewhere between 80 and 99? If it's owned less than 80%, then this is we're no longer talking about 332 or 337. If I give you a fact pattern in which a corporation owns 78% of the stock of another corporation, and an individual owns 22%, that might be a trick question, because that would simply be analyzed as a regular 331 liquidation. We're only in this world of subsidiary liquidations if a parent corporation has 80% or more of a subsidiary. So now, we have a minority shareholder here, owning, in this example, 20% of the stock. And we assume the parent has a 40,000 basis in its 80% stock interest, and the minority shareholder has a $15,000 basis in its 20% stock. We assume that the sub owns land with a fair market value of $80,000 and a basis of 30, and 20,000 of cash. So in other words, 100,000 of total assets in the subsidiary, which is going to be distributed 20/80. And in this example, we're assuming that the land worth 80,000 is distributed to the parent corporation, and the 20,000 of cash to the minority shareholder. And we're also assuming that we complied with the procedural requirements of 332. What happens? Well, at the subsidiary level, nothing happens. because we have a distribution of appreciated property to an 80% or more parent stockholder. Even though that's a realization event, it's still a non-recognition event under 337A because this is considered to be a valid 332 liquidation. At the parent level, also same as the previous examples. No change to the fact that the parent has no gain or loss recognized under 332. The change here is the minority shareholder. But before we get to the minority shareholder, just a reminder that the land that had a basis in the hands of the subsidiary of $30,000 is transferred over to the parent corporation, and the parent's $40,000 basis in its stock is permanently eliminated. And also, as in the previous example, the parent's holding period in the land is tacked, and it gets the E&P, etc., of the subsidiary. I'll skip the advanced issue, although it's an interesting question. Remember, I told you the earnings and profits of the subsidiary migrate up to the parent in a 332 in a subsidiary liquidation. What happens if the parent owns only 80% of the stock? Does the parent get 80% of the E&P or 100%? I don't know the answer. Okay, so let's talk about the minority shareholder here. Even though this is a tax-free 332 liquidation for the subsidiary and for the parent, the shareholder has to be treated under section 331 and therefore has a recognition event. Receives $20,000 of cash, minus basis of $15,000 in her stock, $5,000 of gain under section 331. And to see how this plays out, skip quickly to the next example. Same exact facts, except the minority shareholder, instead of getting $20,000 of cash, gets $20,000 of property. Assume that the subsidiary had a $20,000 property worth $20,000 with a basis of $10,000, which it distributes to the minority shareholder. What happens at both levels? The distribution of the building to the minority shareholder, unlike the distribution of the land to the parent, is not eligible for favorable treatment. Instead, the subsidiary picks up a $10,000 gain on the distribution of the property to the minority shareholder. $20,000 of value minus $10,000 of basis, even though in this example, we're assuming an $80,000 property with a base of $30,000 is distributed to the 80% parent corporation. That's still a non-recognition event at the subsidiary level. So you get the picture here. You have a bifurcated treatment under which the subsidiary avoids a taxable event to the extent that it distributes appreciated property to the 80% or more parent corporation, but not for the stuff that gets distributed to the minority shareholder. And at the level of the minority shareholder, there's really no change in the analysis here. In other words, it doesn't matter whether a minority shareholder receives cash or property. In this type of liquidation, the minority shareholder, 20% or less, is simply not entitled to non-recognition treatment. It's treated the same way that an individual would be treated in a 331 liquidation. So the minority shareholder has gain of $5,000 on receipt of this building, 20,000 minus the $15,000 basis in its stock. There's a typo there. No, it's correct. Yeah, for a second I got nervous, but no, this is correct. I thought this line, shareholder M's adjusted basis in substock is correct. Sorry about that. I always get paranoid when do you ever find that when you are proofreading a document and you've proofread it like 6 times, you start to not read it anymore because it doesn't quite, your brain doesn't quite function the same way. Yes, sir.
I have a question, because I know that these are both similar, these two examples. In the prior example, well, we see in this example the distribution of the building at the result at the sub-level. Why don't we see the distribution at the of the 20,000 cash at the sub-level for the first example? I was curious what would happen with that. Sub-level, results at sub-level for the 20,000 distribution of cash.
You mean where 20,000 of cash is distributed to the minority shareholder?
Correct.
Well,
What is
because
that?
in that fact pattern, we're talking about example 17, where cash is distributed to a minority shareholder. For sure, the minority shareholder has a taxable event under section 331. But at the corporate level, since it's only cash that you're talking about, there's no realization event in the first place when the corporation is distributing cash. In other words, you would only worry about a recognition event at the subsidiary level if I told you that the subsidiary was distributing property other than cash. I'm going to skip ahead to example 19. Which is the last example. Here we have lost property. And don't worry, this is a lot simpler than the built-in loss rules we discussed earlier today. In this example, we assume that the subsidiary has 2 assets. Land with a value of 80,000 and a base of 30,000, and a loss asset, a building with bases of 35,000 and a value of 20,000. And we have 2 shareholders, a parent corporation owning 80%. We assume compliance with the 332 liquidation rules, and we're assuming that the loss asset, the building, is being distributed to the minority shareholder, 20% minority shareholder. So what happens here? Well, normally under the general rule of 336A, when a corporation liquidates, gain or loss shall be recognized. Period, end of discussion, subject to exceptions. The 3 convoluted exceptions we discussed earlier today. And now we know that there's no loss recognized when a subsidiary distributes, whether it's gain or loss property, distributed to an 80% parent. That's an exception. Here, that's not the fact pattern. We have a loss asset being distributed to a minority shareholder. And the code tells us in 336D3 as an exception to 336A, that even though loss would normally be recognized on a liquidation by a corporation, the subsidiary does not recognize the loss if it makes a distribution to the minority shareholder. Don't get confused by that, because the subsidiary doesn't recognize a loss whether it makes the distribution of the lost property to the parent corporation or to the minority shareholder. But in typical tax gobbledygook, the code reaches that end result by a circuitous path. So in the context of the minority shareholder, you only reach that conclusion under 336D3. Anyway, the only other point worth noting in this example where the minority shareholder receives the distribution of the loss asset, what is the basis of the property that's received by the minority shareholder? Well, it's determined under the regular 331 rules, specifically section 334A, meaning that the minority shareholder gets a basis of $20,000 in the building based on its fair market value, even though the built-in loss that was inherent in that asset at the corporate level, remember the corporation had a basis of $35,000, there was a value of 20. The corporation wasn't allowed to deduct that loss, but now the minority shareholder is stuck with a basis of $20,000. So that built-in loss of $15,000 is gone forever. Okay. Basically, the course is over. I want to sort of a half-hearted apology. Again, I guess I apologized at the beginning of the course. I warned you that we would be covering a lot of material intensely in 12, really less than 12 class hours because of the quizzes. And the name of the course is misleading. I don't think anyone would, looking at this corporate income tax basics, you might think, oh, this course is going to be a gut. It's going to be really simple. It's more of a survey course designed to whet your appetite and to sensitize you for the need for very careful thinking. Don't take anything for granted, and just make sure that you read and proofread and check your assumptions carefully. So at this point, as I said, I'll stay for a while. I'm going to now, first I'll circulate, let's do this in a FIFO order. For those of you who didn't get a quiz number 1, I have here, just come on up if you're here. I've got, yeah. No, sorry about that. I don't have your sorry, who's giving me the answer? Is Richard on? And is Taylor knowing? Oh wait, I forgot to give you the answers. Sorry, for those of you who just came up for quiz number 1, I have answer sheets. Sorry about that. now for quiz number 2, I'm just gonna call your names and just come up. It'll be easier that way. Antonio? Oh, just, what I did here is you can keep these. I stapled the what do you call it? The Scantron to your exam, to the quiz. But I also, so your score appears in 2 places. You'll see a mechanically generated number on the Scantron itself, but you'll also see my handwritten score on the first page. Okay? Eric? Julia? Oh, again, I apologize, I have answer sheets. You know what? Pass the answer sheets around. Omar. Right. Emily? Oh, Omar. Harsh? Azim? Brenda? Daniel? Helen? Patrick? Michael? I'm not sure I'm pronouncing this right, so Donna? Did I get it wrong? I absolutely got it wrong. And Phil? Still here? Johnny? So Phil is not here. Okay. How do you want to do this? Do you want, I mean, I could go through each quiz, question by question, explaining the answers, or I could just have a straight Q&A, whatever you prefer to do. Oh, I'm sorry. The one, I should have said that at the beginning. Those of you who took the quiz yesterday, I literally just picked them up 5 minutes before this class. So I could actually, I mean, I could grade them here. I don't want to, what I'd rather do is, the benefit of those students who want to have Q&A or want to go through the quiz, go through that first, and then I won't take, I don't have a Scantron grader machine, I have to grade them manually fairly quickly. So if you don't mind hanging around. But I leave it up to you. Do you want me to go through the quizzes, or do you want to have a Q&A, or do you want to do nothing? remember that the quizzes do not count unless they are better than your final. So the final will be your grade, and if you did better on either or both quizzes, then that can bump your grade up, and everything I explained at the first class.
What was the average for the second quiz?
Well, I haven't finished grading them yet because there are 6 people who took a makeup. However, I can tell you that generally speaking, the class did materially better on quiz number 2 in comparison. I mean, I don't know if it's statistically misleading to give you a breakdown given the fact that I only have 19 out of 25 grades, but I can do that. Out of 19 students who I've grouped, that I've already graded, there are 11 out of 19 got either 9 or 10. 2 of you got 7 or 8, 2 of you got 5 or 6, and 4 of you got between 1 and 4. So obviously the 6 that I haven't graded yet could make a dent in that curve, but I mean, it looks like it's a significant improvement. Again, it's hard for me to tell whether it's partially due to the fact that you studied more for the second quiz, or that I gave you, not that 5 minutes more of material, or maybe I made it a little bit easier, I don't know. Maybe it's a combination of all those factors. The final is going to be I have to change it because I know right now that I've got the draft that I prepared has some questions that are probably unfairly complicated given how quickly we covered through some of the material. Probably going to be about 50 questions, 3 hours, which is, I think, which is I think reasonably consistent with the time allocation for the second quiz. It's going to be a combination of multiple choice, short answer, and I might even throw in some true false. It'll be an interesting experience. It's going to cover all of the topics. It'll be fair. Any questions? Yes.
With the quizzes, if you did better, are they averaged in, or like with your final? Like, are they?
I have not figured out yet. This is going to be a somewhat subjective process. In other words, if I guess all I could say is that the quizzes viewed as a whole, if they are as a whole better than the final, will cause me in an equitable fashion to bump you up to some extent. I mean, it's impossible for me to come up with any quantitative criteria until I see all of the grades in front of me. And frankly, the reason why I decided to do it this way, I debated with myself and with some other people in academia, including my girlfriend who's a professor, what's the best way to motivate the students, and I kind of decided I didn't want to put the pressure on you. I could have said each quiz is worth 10% of the grade, the final's worth 80%, and there's optional class participation that can bump you up and not down. But I was nervous about making the quizzes mandatory because I knew from past experience how hard the material is, and I knew that some of you would have, I don't know what the right terminology is, culture shock or sticker shock. If you're not adequately prepared, you're going to bomb out on these exams. So that's why I decided, okay, the quizzes are just not going to count except to help. How should they help? I honestly haven't figured that out yet. I mean, I would say, without giving too much away, somewhat of a generous grader, and I am, if anything, I'm too forgiving. I mean, I would think that there would be only rare, to talk about the open transaction doctrine, there would be only rare and extraordinary circumstances in which I would even think about failing a student. To me, you've done the work, you showed up, you worked hard, that's enough to, in my view, to get you a passing grade. But, I can't give you a better answer than that in terms of what impact the quiz is going to have. It's going to be totally subjective. And you can't really complain about it because it's only going to help you. But yes?
Will the final be more based on like post-quiz 2 stuff? Or
No, the final is going to be
like
a little bit of everything. Which I think is for your benefit in the sense that this will, I know it's painful, but it will force you to go through the material. And I've always found that in my days when I was a student, that the mere process of studying for an exam was part of the learning experience. And even though very often after I took an exam, I would feel like crap, I would feel, oh my God, that was such a miserable experience. It often I would do better than I thought I had first done. But I'll do my best to insert questions that are not, trick questions. I'm going to try to be fair. There will be, for sure, there are going to be some hard questions because, that's part of my philosophy, which is that you need to be challenged. Here's a good analogy, a sports analogy. When I used to play sports, whether it was basketball or tennis, I would always like to play against athletes who were either at my level, who were a lot better than me, occasionally if they were worse than me. It's part of the learning process, and I think, maybe that's not a great analogy, but I think you need to be challenged by your teachers so you can see the elasticity of the learning process. Some of you, I'm sure, are going to come away from this course hating tax. And that's completely cool because I'm speaking mainly from the perspective of lawyers I know. Most lawyers I know who took the basic tax course in law school came away pretty much hating it, okay? And practicing attorneys, they have to put up with us tax attorneys, and in a very grudging fashion. They just can't deal with it. So I get it. It's a necessary evil for many of you. So I understand that each student in this course will have different goals in terms of what you're trying to get out of the course. And that's okay. And, you never know what you might specialize in. Sometimes it's a matter of historical accident. There are plenty of people I know, whether accountants, lawyers, just, anybody. Your career often is dictated by who you meet or the next project that you work on. You stumble upon something that you realize, hey, I really like that, or you're really good at it. And one of your superiors says, hey, you did a great job on that project. And then they give you another assignment in the same subject matter. And before you know it, you're considered the resident expert. So keep an open mind about, what subject matters you end up specializing in. Anyway, enough of my philosophizing. Any questions on